reject the face value of the ledger. Accounting analysis serves as the vital bridge between strategic analysis and financial analysis. It is the forensic filter through which we must pass historical data before it can be used for valuation. You must understand that financial numbers are not objective truths, but distorted representations of economic reality. A mechanical reliance on spreadsheets, treating them as a series of automatic, self-evident truths, is a dangerous exercise. Without understanding the strategic and behavioral context behind the reporting, complex financial models become garbage in, garbage out scenarios where information is not only useless, but actively misleading. Here is your content exactly as is, no changes made, with the original structure preserved. Mastering Accounting Analysis and Valuation, a comprehensive study guide, strategic imperative of accounting analysis. The analyst's first duty is to reject the face value of the ledger. Accounting analysis serves as the vital bridge between strategic analysis and financial analysis. It is the forensic filter through which we must pass historical data before it can be used for valuation. You must understand that financial numbers are not objective truths, but distorted representations of economic reality. A mechanical reliance on spreadsheets, treating them as a series of automatic, self-evident truths, is a dangerous exercise. Without understanding the strategic and behavioral context behind the reporting, complex financial models become garbage in, garbage out scenarios where information is not only useless, but actively misleading. Based on the Mohanram framework, financial distortion stems from two primary sources. One, managerial intent. Managers possess insider knowledge and utilize the latitude provided by accounting standards to influence how the company is perceived. While this discretion can be used to provide a nuanced picture, it is frequently exploited to manage earnings to meet specific capital market benchmarks or secure personal compensation. Two, accounting standard constraints. Distortions often arise from the rule book itself. Rigid standards, such as the requirement to expense research and development (R&D) or the reliance on historical cost, can act as a straitjacket. This rigidity often prevents managers from reporting the true economic value of assets or the unique business model of the firm, even when they wish to do so with integrity. To move from these distorted representations to an actionable valuation, the analyst must first master the structural organization of these numbers within the core financial statements. 2. The building blocks, financial statements and the accrual engine. Financial statements are not isolated silos. They are a singular, integrated engine. Central to this system is the accrual accounting assumption. Transactions are recorded when they occur, not necessarily when cash changes hands. While cash flows are essential for liquidity analysis, the so what for the analyst is that markets value earnings and PE, price to earnings ratios, far more for forecasting. Markets respond to earnings changes even when cash flows are stagnant because accrual-based numbers often possess higher predictive value for future performance. Understanding the core statements, the balance sheet, the snapshot. This statement provides the accounting value of a company on a particular date. Following the identity, assets equals liabilities plus equity, it is a still photograph of the firm's cumulative financial position. The income statement, the motion picture. This report summarizes financial performance over a specified period. Like a film, it captures the activity, revenues earned, and expenses incurred that resulted in a profit or loss. The cash flow statement, the liquidity report. This demonstrates the company's ability to generate cash from operations and how it utilizes that cash in investing and financing activities. Technical clarity. Accounting recognition treatments category, recognition criteria, Mohanram framework. Revenues, recognized when earned through an increase in assets or a decrease in liabilities. Requires transfer of risks, rewards, loss of effective control, and reliable measurement of costs and payment probability. Expenses, reductions in equity, not distributions, recognized by matching them to the specific revenues earned in the same period. Assets, resources controlled by the firm as a result of past events from which future economic benefits are expected to flow. Liabilities, present obligations arising from past events, the settlement of which results in an outflow of resources. While these concepts form the foundation, the specific rules of the game vary depending on which global jurisdiction a firm inhabits. 3. The Global Rulebook, US GAAP versus IFRS. Accounting standards are not universal laws of nature. The harmonization project between the FASB and IASB International aims to lower transaction costs for global capital raising, yet significant strategic differences persist. Comparative Accounting Standards Dimension, US GAAP, IFRS orientation, rules-based, detailed, rigid requirements, principles-based, relies on conceptual frameworks and judgment. LIFO inventory allowed if used for tax purposes, prohibited to ensure consistency. Inventory write-ups, generally prohibited after a write-down. Allowed, reversals are permitted. Fixed asset valuation, rigid emphasis on historical cost, allows for revaluation to fair value if measured reliably. Extraordinary items, separates unusual and infrequent items, does not recognize this concept. The analyst's evaluation. The rules-based nature of US GAAP is a byproduct of high litigation risk. US auditors prefer rigid check-the-box rules to defend their work in court. However, this creates the aforementioned straitjacket, potentially obscuring a firm's nuanced economic reality. Following major auditing catastrophes, e.g. Enron, WorldCom, the Sarbanes-Oxley Act, SOX, revamped auditor responsibilities and established the Public Company Accounting Oversight Board, PCAOB, to provide a stringent layer of oversight and prevent conflicts of interest, such as auditing firms providing non-audit consulting services. Once we understand these global constraints, we require a surgical framework to apply these rules to a specific firm's reporting. 4. The 6-step framework for forensic accounting analysis. A systematic approach is required to undo distortions and identify the key accounting policies specific to an industry's success factors. Step 1. Fit with industry structure. An analyst must identify where distortions are most likely to manifest based on the business model. Airline industry, focus on fixed assets, lease accounting, pension accounting, and accounting for derivatives. Software industry, focus on intangibles, M&A accounting, and stock options. The 6 stages of analysis. 1. Identify key accounting policies. Pinpoint the policies most critical to success and susceptible to manipulation. 2. Evaluate accounting flexibility. Determine how much latitude GAAP allows, e.g. high flexibility in retail inventory obsolescence versus low flexibility in R&D expensing. 3. Evaluate accounting strategy. Compare choices against peers. Is the firm aggressive or conservative? 4. Evaluate disclosure quality. Look for quantitative details in footnotes that go beyond the minimum requirements. 5. Identify red flags. Search for warning signs of poor governance or pressure to perform. 6. Undo accounting distortions. Restate the numbers to produce cleansed data for valuation. Categorized red flags. Revenue-related, channel loading, receivables growing faster than sales, or premature recognition before goods move. Asset-related, unexpected large write-offs, unexplained changes in depreciable lives, or an increasing gap between net income and cash flow. Audit-related, qualified audit opinions, frequent changes in auditors, or large fourth-quarter adjustments. This framework moves us from qualitative policy assessment to the quantitative reality of how management plays the numbers game. 5. Earnings management, navigating the numbers game. Earnings management is the intentional misstatement of results to meet benchmarks. Missing a target by 1 cent can cause a precipitous stock price drop, creating a non-linear incentive for managers to manipulate numbers as they approach specific thresholds. The 3 primary types bump up. Upwards manipulation to clear a benchmark, e.g. analyst expectations or debt covenants. Big Bath. When a firm is far below its target, it may report intentionally worse results today. By taking massive charges now, they clean up the balance sheet, making future turnaround performance appear miraculously reborn as income. Cookie jar. When a firm is far above its target, it may hide excess profit by increasing provisions. This avoids the ratchet effect, the tendency for overperformance today to lead to impossibly high expectations tomorrow. These saved earnings are then tapped during lean quarters. Strategic incentives. 1. Debt covenants. Managers manipulate accruals to avoid violating accounting-based ratios, like interest coverage imposed by lenders. 2. Management compensation. Bonuses tied to net profit or share price provide a direct motivation to accelerate revenue or delay expenses. After cleansing these managed numbers, the analyst proceeds to the prospective analysis phase. 6. Forecasting, anchoring the future in revenue. Forecasting transforms historical data into valuation inputs. A robust forecast must be integrated, realistic, and anchored in revenue growth, the anchor assumption from which all other line items flow. Forecasting approaches, detailed forecast, forecasting every line item. While it offers tedious accuracy, it often results in volatile ratios and may be unnecessary unless one is a credit provider interested in specific assets. Condensed forecast focuses on key aggregates. This approach utilizes fewer assumptions, leading to reduced volatility in the model. The logic of mean reversion. A vital duty of the instructor-analyst is to remind students of mean reversion. ROEs and ROAs tend to return to average levels over time, primarily driven by mean reversion and profit margins. Analysts must not forecast 20% growth indefinitely. Competitive forces and market saturation inevitably pull performance back toward the mean. The net assets integration. To ensure the balance sheet remains integrated and self-correcting, we use the net assets logic. Operating working capital plus net long-term assets equals net debt, shareholders' equity. 7. Exam prep, concept mastery, and practice problems. Technical focus, the Jones model. To identify manipulation, we separate discretionary accruals from non-discretionary accruals. Non-discretionary accruals represent natural growth, e.g., higher sales naturally increasing receivables. Discretionary accruals are the artificial fluff. The Jones model uses regression to estimate the non-discretionary component. The residual, the difference between actual and predicted accruals, is the discretionary portion that flags potential manipulation. Data analysis task, the basic identity. To calculate net capital, you must map the raw balance sheet using the basic identity A plus B plus C equals E plus e.g. like A, cash and marketable securities. B, other current assets. C, long-term assets. D, short-term debt and current portion of LTD. E, other current liabilities. F, non-interest-bearing long-term liabilities. G, interest-bearing long-term liabilities. H, total shareholders' equity. Step-by-step calculation. 1. Calculate net assets. B minus E plus CF. This is operating working capital plus net long-term assets. 2. Calculate net capital. D plus G minus A H. This is net debt's equity. Note, net assets must equal net capital. Practice problems. 1. Scenario analysis. A hurricane destroys a factory in Saskatchewan. Categorize this transaction. Answer, non-recurring and peripheral. Logic. It is non-recurring because the geography central Canada makes a hurricane an event not reasonably expected to occur again. It is peripheral because it is a loss resulting from an act of nature, not the firm's primary operating activity, e.g. selling goods. 2. Red flag identification. Accounts receivable are growing at 30%, while sales are growing at 5%. Name this distortion. Answer, channel loading. This suggests management is booking revenue by shipping unrequested products to retailers to meet short-term targets. 3. Forecasting logic. Which line item drives a pro forma model and why? Answer, revenue. Most other line items, COGS, SG&A, working capital, are naturally tied to the volume of business generated. Beginner's cheat sheet. Accruals, the difference between net income and cash flow. Discretionary accruals, the portion of accruals resulting from management's accounting choices rather than underlying economic activity. Asset, a resource controlled by the firm expected to provide future benefit. Liability, a present obligation resulting in a future outflow of resources. Equity, the residual interest in assets after subtracting liabilities. Mean reversion, the tendency for financial ratios like ROE to return to a long-term average due to competitive pressure. If you want, I can next turn this into one-page exam cheat sheet, Excel-ready